Welcome back, everyone. Today, I want to talk to you about what we call the different types of order blocks. I'll go over each example, show you what to look for in terms of the pattern on the chart, in terms of what price will do, and how you can know where to place your entry. So we have the breaker block, mitigation block, the propulsion block, the reclaimed block, and the vacuum block. I had drawn out some examples, but I'll tell you what the rules are as it relates to each block. So for the breaker block, you're going to be looking for a purge of liquidity, sweep of liquidity, grab liquidity, draw liquidity, however you term it. Once price takes out liquidity, you're going to look for a sharp reversal of price, which breaks structure. While it is breaking structure, it is going to violate the order block. So it's not going to stop. It's not going to pause anything. It's going to violate the order block. Then price will return to the order block, which is now considered a breaker block. And it is at that breaker block that you will be looking for your entries. So if you're on the, for example, the 1 hour time frame, and you saw where price violated the previous low, previous high, which is where liquidity will be resting, you're going to be looking for a break of structure, and you're going to be looking for price to return to that block. You would then go down to a lower time frame, refine your entry, and set your pending order, whether it's a buy limit, sell limit, and wait for price to return there. So an example of the breaker block, you will see, so this is where liquidity was swept, and then price reversed sharply, breaking structure here, and then price pulled back, mitigated the order block that is here, and then rallied off. And this is an example of what a breaker block would look like. Always look for the liquidity sweep, the break of structure, and the return to the block. Your entry would be right in here. The next example is the mitigation block. It is very similar to the breaker block, but the difference is price. There's no liquidity sweep. Price will never break this low, or if it was a high, it will never break that high. You will either have double tops, double bottoms, or triple tops, triple bottoms, or a shift in market structure, or change of character of price. And with that, you'll see a break of structure. And with the break of structure, the return to this block here, not this one. And this would be mitigation block. So let's go over that again. Price will not break this low. It will either come as an equal low or a shift in market structure. You'll see a break of structure and a return to the mitigation block here. Your entry would be here. You'd again refine your entry to get a better risk to reward ratio, and price would rally off. These are obviously bullish examples. You can just do the reverse for the bearish example. The propulsion block is where you'll have 1, 2 order blocks in the same area. For each one, there's a break of structure. So price comes down, creates the order block, price rallies, breaks structure, comes back to the same area, rallies, breaks structure, comes back, mitigates this order block, and then rallies off again and breaks structure. I'm not sure if you've ever noticed this pattern in the charts. This is what it would look like, and it is called a propulsion block. In this example, this is the reclaimed order block. And if you're looking at this, you're basically seeing the ICT market maker buy model. And it usually tends to play out this way. You'll have price coming down in the sell, and this will be the distribution. And for each order block, they would not be mitigated yet until price is accumulating and the price is going into buys. You'll see that the order block over here will mitigate this one. This will mitigate this. It doesn't always fall in the same order or so neatly or so predictably, but you will notice that that is what will happen. Maybe the order blocks don't fall so much in line as I have drawn this out, but that's what would happen. Price would reclaim the order block on the other side of the buy model, and that's how it would go off. Right. In terms of the vacuum block, I didn't draw that out yet. What you would notice is price would do something like this. It doesn't matter what price does, but what you'll notice is a gap in the price structure. So something like that. What happened there? Oops. So you'll see something similar to this. So price goes off and it's within this gap here that you would be looking for an entry. These gaps tend to form with volatility in the market over the weekends or with the news and stuff like that, especially over the weekends, I would say. And it depends on the asset as well. Some assets carry, especially shares and stocks, you'll tend to see a lot of gaps in the prices. What tends to happen is that price is drawn to these gaps because there is a pool of liquidity sitting there. There are orders sitting in those gaps, and price will return to draw on the liquidity, resting here, and then continue in the direction that it's intending to go. So it's not a very popular execution block, but it's very well known, I would say, and it is an area of interest that you can look at as a possible place to get a trade set up that is successful. And yeah, those are the different types of blocks: the breaker block, the mitigation block, the propulsion block, the reclaim block, and the vacuum block. I hope this video helped you to bring some clarity to the different types of blocks and how you can execute orders from the mitigations of these blocks. Of course, if you have any further questions, please let me know in the comments. Remember to like and subscribe, and we'll be bringing more content to you over the next few days. Have a great day. Thanks and bye. Take care.